We're mostly buying properties at a fraction of their replacement cost. A lot of the properties statistically were built in the 60s, 70s and 80s, which means it's probably not economic to build new properties in most towns. For a leasehold, you're basically geared twice, once through the bank and once through the landlord.
You think a lease would be more risky then, and I think it's less.
Risk is where you make money. So if you take no risk, you make no money. It's taking the right risk and knowing how to mitigate that risk that's important.
Welcome to Resort Brokers Radio. I'm Trudy. We're going to walk you through the ever-evolving landscapes of hotels, motels, caravan parks and management rights. Here we have experts from all across the accommodation industry, and we've invited them along to tell us all about their success stories, the lessons they've learnt, what their predictions are for the market going forward and what trends they're seeing. Please join us. We look forward to seeing you there. Hello and welcome back to RB Radio. I am very excited about our next guest, the one and only Mr. John Zeckendorf from Mandala Hotels and Resorts, previously of Asset Solutions. When did you rebrand, John?
Well, when we decided to do a lot more in hotels and resorts.
Yeah, see, I always think you've been so dominant in the space. Anyway, thank you so much for joining us.
Yeah, it's great to be here.
Yes, after us, when we started doing these about 12 months ago, you were the top of my list, but because you've been buying and operating so many properties across the country, you've been a hard man to pin down, so thank you.
Indeed, it's a rare pleasure to be in the same city.
Isn't it? Very rare. So tell me, John, how is the world, maybe for the sake of the listeners or the watchers, tell us a little bit about your business.
So Mandala Hotels and Resorts has been around for just under 20 years now. We started off with one property, decided that was a good idea and just basically kept growing. Sadly for resort brokers, we're not very good at selling. We tend to buy and hold properties very long term. We started off doing it for ourselves and then accidentally formed our first fund, second fund, third fund, a couple of side funds and a pile of other things. So we're up to about 40-something properties now.
Wow.
We're regional experts.
You are.
And we kind of specialise in smaller properties.
When you say smaller, because we obviously had the launch of the motel report, the first industry motel report last week, which was very well received, and I think good for the industry with all the capital that's coming in, and for your investors, well, I'm sure they'll be interested in it too. But when you say smaller properties, you know, there's only 4% of all motels across the country. When we say motel, 2 stories, parking out the front, and up to 50 keys is generally where we've come up with the terminology. Yes. When you say smaller properties, when only 4% of them are over 50 keys, what would be the average size of your property?
The average size for us is probably somewhere around 40, 50 keys.
So that's quite big for the space, motel space, but maybe the hotel space.
Well, the line kind of gets blurry. Hotel in the country tends to mean pub. Yes. And that's we don't do pubs.
No.
So our smallest property is 19 rooms.
Yes.
We've got two in the 20s, about 4 or 5 in the 30s.
Yes.
And then it goes up to there. The average for us is probably skewed by a couple of much larger properties that are in there. So, yeah, that drags our average up a little bit. But, yeah, we're quite comfortable with smaller properties, and we're in 5.5 states at the moment.
I know. I know. You've got great coverage. I genuinely mean that. Obviously, we're so dominant in the regions too.
No, that's
and that's where we met. I think we met under a tree in Catherine.
Indeed.
When we did our first deal, many deals ago.
We did.
And so, of the 40 properties you've got, what's maybe drilling a little bit? People get excited when they hear about funds.
Okay.
And yet I know what a cautious and like you're a great buyer to deal with. You know what you're looking at. You're commercial in regards to your view on things, but you're very thorough, which if people are giving you their money, they'll be happy. But how do your funds work and how do you raise the capital for them?
So every fund has a purpose set out in the fund documents. Yeah. So the first fund was a leasehold only fund.
Yes.
So the returns on that were fabulous.
Incredible,
and awesome yield, but less on the capital side.
Yes.
But a very different risk profile. Leasehold's a totally different risk profile.
And so in your mind, right, so obviously when did you first buy your first lease?
2010, So 15.
Okay, so the market's moved a lot in that time.
It has.
And obviously we've had the big C in COVID in the middle, which brought in the leasing code of conduct.
Indeed.
Depending on where you sit on that, there's a lot of opinions.
We sat on both sides of that.
Well, you're a landlord and tenant,
We're a landlord
right?
as well.
Exactly.
Yes.
But when you say different risk profile, unpack that for me.
So for a leasehold, you're basically geared twice, once through the bank and once through the landlord. And so in a rising market, that's fabulous. So if you think the property has upside, having a lease is great because you get the magnification of that in terms of your income.
Yeah.
But your capital growth is only 3 or 4 times what you can increase the bottom line by.
Yes. Okay.
Whereas if I'm an owner-operator and I have both the land and the business, then if I can raise my business by $100, I'll get, in a leasehold, I might get $300 or $400 of extra value on my capital.
Yes.
But if I'm an owner-operator, then I'll get, $1,000 or $1,100 or something like that. It's a much bigger number if I think there's upside. If there's downside and I'm worried about, this property is overcooked and we think, it's trading fabulously at the moment, but it's not sustainable,
you can take it, yes.
then actually your rent goes up by inflation, your other costs go up by inflation or more, and so all your biggest costs go up. But if your revenue doesn't go up by more than that, you're actually going to erode away, and that's why we see a lot of leases out of balance.
Yeah, I mean, I don't know if we do anymore. I do think that in 2010, particularly, and interestingly, again, it's only because it's fresh in my mind, but if you look at the OTAs coming in, which obviously just ate out of people's bottom lines, but also a lot of rents were reset, particularly across mining locations and big regional locations with the mining boom and bust. So they were set at probably high proportion. And look, no one could foresee that would turn off so quickly. Yes. But you see, isn't it interesting? You think a lease would be more risky then, effectively, and I think it's less.
Well, but don't forget, risk is where you make money. So if you take no risk, you make no money. It's taking the right risk and knowing how to mitigate that risk that's important. And for years, the diamond structure worked fabulously when we started this. The idea of splitting, I was getting to that, splitting basically owner-operated property into landlord and tenant.
Yes.
And that worked fabulously because of the yields that were available at the time.
Yes.
It doesn't work so well today because the difference between a passive yield and an owner-operated yield, what we call an active yield, is too tight. You don't have that spread to carve out room for a lease anymore. And I think that's why you're seeing a lot less new leases being created now than we did 15 years ago when we started in this.
Do you know what? I think also post-COVID, there's been a whole new lot of money coming into the space. And I think that's because, obviously, there's a lot of capital out there. There's a lot of money out there looking for a home, right?
Yes.
But also, compared to other asset classes, it still represents good value, whatever lease freehold. But I think the underlying drivers of the industry make sense to people. If you're in a housing crisis, no one's building a hotel. And if you've got rooms in a growing population, you can't lose long term, and I think people will feel more comfortable about the sector than they did previously, maybe.
Look, we think we're a part of that because we've been yelling this for about 17 years now.
Yes.
And
you really have been.
We're actually hearing our own arguments echo back to us, and we're like, but one of our big things, to echo what you're saying, but in a slightly different reason, is the replacement costs. Most of these country towns, a lot of the properties statistically were built in the 60s, 70s and 80s when building costs were different, land costs were different, labour was totally different.
Yes.
Fast forward to now, the building costs are prohibitive, and we're mostly buying properties at a fraction of their replacement cost, which means it's probably not economic to build new properties in most towns. Now, there's a bunch of towns where the rates are high enough and the RevPAR's high enough that it does make some economic sense. It can always make economic sense to renovate, because if you can improve the property, you lift your ADR and all of that works nicely. But to do a greenfield new build, there aren't an awful lot of places where that makes good economic sense. Even if you've got modular stuff and cheaper ways of building and faster ways of building, you just can't get there. We're buying stuff in some towns as little as 25% of replacement cost.
Unbelievable.
So for us to buy it at that, and there's one property we looked at that we're actually spending more renovating it than we did buying it.
Wow. How long ago did you buy that? I mean, I know that we're in a market where everybody's having such good trade, and maybe this year it's normalising slightly, but it's, I think with the dollar being so low, Australians loving a holiday. The domestic tourism's staying stronger. If you look at properties like Port Douglas, you look how well that's trading still. You know, it's not, the tide's not going out on the domestic tourism quite as fast as I thought it was going to be.
Quite the opposite, actually.
Yes, exactly.
But
right.
there are some soft spots.
There are some spots that have definitely had a sugar hit that probably hasn't been sustained.
Yeah.
Maybe not leisure spots as you'd think of it. I think there's some places where they were getting $600 a night for 2 nights, and you wouldn't think of them as weekend.
And in some pretty crap quality hotels were charging that as well. So, yeah.
Repositioning dreams, John, is what we call them.
Repositioning is, when we first started this, you added value by getting rid of the bedspreads, changing the signage, creating a website. Seriously, it was that easy.
Yeah.
And that was enough to differentiate you from most of the competition. Yes. Then the OTAs rose and that all changed. And so a lot of it became about what your online strategy was and distribution strategy.
Yes.
And then, triple sheeting came in. There's all these little innovations that have come along. And then we thought, okay, we could do a light renovation and that'll be enough to differentiate us. You've got to the point where all those easy goals have been kicked and most other people have cottoned on to that now. So you've always got to be ahead of the curve and push up. And so now, repositioning is a big one.
Yes.
We're starting to see a number of our properties where we're buying them. We bought one in for a $9 million acquisition. We put another $4 million into it.
Wow.
We've only just completed on one that we bought for $7 million and we're putting another $4 million into it.
Okay, and so when you go out to your investors...
So that's heavy repositioning, which is what you're talking about.
Yeah, no, exactly, and that's fantastic.
This is taking it from, something that was charging, $150, $200 and bumping it up by $50 to get that return on the money we're spending.
Yes, so do you find twofold? Do you do it because it's feasible, but does it make the returns better, or does it just make the property ahead of the curve? You think it's
both. If you can spot a niche in the market and find enough customers that are willing to pay an extra $20 if only they had 1, 2, 3, 4.
Yes.
It's not just $20 actually. In a lot of regional locations, you can say we can get another $80 if we only offered something that nobody else does. And that's not just the physical product, but there's no point having 4.5-star service and all the extra features if the rooms are crap. No. You've got to have all of that work together. But it's very much a matter of knowing your customers and being able to drive them there. So we're big enough now that we've actually got quite a database of customers. Yeah. It's not a loyalty scheme, but they do respond to electronic mail-outs.
Oh, great. So you're driving business.
So we've got customers that are used to paying $600 in that location a night.
Yes.
And if we can say to them, hey, we can give you a similar experience, but over here, would you spend $500 over here?
Yes.
The answer is, oh, yeah, because we want that level of experience. I want my weekend away with my wife or whatever it is.
And do you offer that? Do you do it?
We are doing a lot more what we call cross-pollination, where we're basically saying, let's carve up our whole database and say, okay, those guys, and this is specifically on leisure. We do different things on corporates, but on leisure, these guys are saying, we want that weekend away with the family or a reconnect or a baby moon or whatever it is.
Yes.
And I don't really mind so much whether it's here or here. I'm looking for that level of elevated experience and I'm prepared to pay for it.
There's been a lovely reset, isn't it? Nice to think that people are prepared to pay. I think...
Well, some people are. Other people are... And this is actually where there's not having a specific product that has to be, 5-star, 4-star or something like that. We cover the whole spectrum, which means we can actually, in the right location... There's no point having a 5-star resort in the middle of the outback.
Well, not in a workers'
unless
town.
You're in El Crestro or something like that.
Doesn't mean that you can't look at the territory. Look at places like Catherine. Look how great that property is. Fantastic is. It's such a good example. Your one's in Darwin, exactly the same thing. Perfect for what the clientele is there, right? Darwin's apartments. Yeah. Catherine's a park, more cabin style. I mean, that's great, right? That's perfect for those locations.
Yeah, and the example we often give is Bathurst and Orange are right next door to each other, like they're 45 minutes apart.
Yes.
Gee, those towns are different.
Aren't they?
Such a different personality. Yes. Wagga and Albury, same thing.
Same thing. But, I mean, all
they're
great
only an hour
towns.
apart. They're great towns, but they're so different. So the product I want in Orange isn't the same product I want in Bathurst.
How interesting.
Because they're very different towns.
How much time do you give to think to that? Like, how
Whole
do you
lot.
come about that? I mean, I know you've been travelling the country for 20 years, like I have, looking at them. But
Actually,
and
about
I know
50 years I grew up travelling the country.
Yes,
so-
and I know Brian
Yep.
Shaw, your business partner and co-founder of Mandala. But how much? Is there anywhere else that you get your inspiration or your feedback on what kind of product and what town?
Look, and most of the resort broker agents call me up, and the ones that don't know me and go, when are you doing a site inspection? And you're like, that's probably the last thing on the list.
Good thing is you're honest with this, and man,
Totally.
we
It's like
appreciate that. You know,
We've done, I mean, you know how many deals we've done. I'm
gosh,
not even sure the number.
I think we've done 10, haven't we?
Oh, no,
11?
lot more than that.
You and I?
Yeah. But between your team, yeah,
I
absolutely.
know, beg your pardon,
Yeah.
sorry.
You
It's
and
all
I
about
have
you and
probably
I.
done
I
that.
think we've
yeah.
done about 10.
But then we would have done the same again
absolutely.
with the rest
I think
of
we
your
were up
team.
to nearly 15 or 16.
Yeah. So a lot of those...
Till we've sold all 40, I won't be happy, John.
Noted. I think Trudy wants to leave that in, please. So it's on the record. But seeing the property is one thing. These days you can do a lot of desktop research.
Yeah.
Fortunately,
Data's everything, isn't it?
Well, fortunately, every property has about 500 hotel inspectors who stay at it regularly, so we can actually see what the guests want and don't want and what they're upset
they'll tell
about.
you if you listen, won't they? Isn't it an interesting thing?
Well, we can run reports on individual properties, and so it comes up with a trust use score, which basically rates their property, and it's kind of fascinating. You get a very quick summary on what that looks like and what the market is saying about it.
And when you go through, have there been any instances where you've walked through or Ryan's walked through and you've disagreed, or is it normally pretty spot on?
Oh, by the time we get, I don't think we've ever walked into a property and gone, yeah, okay, we got this wrong.
No. It's always the last thing almost, isn't it?
There are a handful of physical things you can't change, like the ceiling heights, the room sizes are tricky to change.
Yeah, the room sizes are normally good though. That's actually a good thing about regional properties.
If you know the age of the property, you've probably seen 5 others like it already.
Exactly, but generally they're solid and big rooms.
And you can tell from the photos when they're using the wide angle and all that. And the guest feedback again. I mean, we had 13 square metre rooms in Moree.
Yes.
But gee, it was perfect for the market.
Absolutely, it was such
there was a whole bunch of transit people that just wanted a cheap room, clean, hot shower.
Absolutely. I mean, Moree, except for heaven forbid the flooding, it's good town.
Yeah.
Busy town always. It is again now.
Yeah, absolutely. We're out of Moree.
No, I know, don't worry, but it is a busy town.
I think you got us in and out, didn't you? That was some time ago.
It's surprisingly busy, exactly like what you're saying. So, sorry, going back.
So it's having the right product for what the customers want. And if not, can we change the product to where the opportunity is?
And does it make sense on the back of the piece of paper almost? And
well, it starts with the piece of paper, and then you've got to work out physically, are my assumptions correct? Now, we've been doing this a long time. We've been kissing a lot of frogs, so we've got a fair idea of what's likely to happen.
You've found a few princes, though, haven't you?
Oh, we've found some awesome deals.
You have found some awesome deals. Yeah, we'll keep that and stop that analogy going. But just one more question before we go and talk about your actual funds and your investors and what you think the opportunity is and what the appetite is. But just I'm interested in where you got the rating from reading everybody's reviews. Do you find that I get a lot of feedback from vendors that they're overly negative and sometimes, and I think that's short-sighted. I agree with you. You know, like it might be that you've got the odd person going there and why would you go and complain about the type of coffee? But there's also often a lot of valid things in there.
Coffee is so important.
It's so important.
It's so easy to fix.
It's so easy to fix. Exactly. But do you find that normally your opinion's the same, or do you find that you always take it with a grain of salt?
We take it with a grain of salt.
Yes.
Look, people generally write reviews because they're upset.
Yeah, they do. They don't get
so
on
there is a negative
great.
bias in them. If you had an okay to good experience, which is kind of what you're hoping for, a fantastic experience is lovely, but maybe you're over-servicing them or they're just happy people.
Yes.
So we do look, sometimes if there's a small number of reviews, we will actually look at who gave them a 5, who gave them a 1, and you can actually flip it and see what the reviewer did on other properties.
And
if you notice they're really a grumpy person that always gives 1s and they complain about everything everywhere they went, you'll probably discount that out of the...
Wow, John, I didn't know you do that much work behind the scenes on it. Good on you, amazing.
Well, look, sometimes we know the property. I mean, quite often we've already seen the property years before.
Yes.
A number of times, many occasions, we've actually gone back to the agent and said, actually, this was a problem with the property last time we looked at it, and that's why we didn't buy it 5 years ago. Have they fixed it? And the agent's like, Fixed what? So often we know an awful lot about the history of the property.
Well, the industry's not that big when you're as ingrained in it as you are. You know, it's not that big.
There's about 2,000 properties that are in our wheelhouse of
There are.
big enough and, bigger than mum and dad looking for a
Totally.
job and able to be run under external management. And we don't buy in the cities. We operate in the cities, but we don't buy in the cities.
And what's the idea behind that, John?
Competition in the cities is enormous, both for purchasing
Yes.
and therefore the yields. If I
Don't
want to buy a 5-star in Sydney, Melbourne, Brisbane,
Yes.
I'm probably looking at a 3-4% yield,
Yes.
and there's probably 60-70 underbidders.
Yes.
I want to buy a property in the regions. I'm looking at 8-9% yields
Yes.
with a lot less competition.
Yes.
My competition are often mums and dads. They
Who
don't
might
have.
have been there for a long time, or
They can be tired. They may or may not have the money. They may or may not understand distribution, yield management,
Yes.
social media. They don't have a sales team. There's so many
no
layers of value we can bring, and we're bringing it against a lot of competition that don't actually have that skill set or those resources.
and I agree.
And so
with
we
that,
always
yes,
describe
of
it as, we're not trying to put mum and dad out of business,
Of course, you're not.
but because we've got a contract with Commonwealth Bank and all the banks and all the petrol companies and all the food places and all
So
of
when you say
those,
you've got contracts with them, they stay in your properties across country.
they stay in our properties across the country
Wow.
because they can't get that from lots of other places, and they won't go to an individual mum and dad. The corporate
No.
travel agent won't put somebody with a mum and dad because it's high risk for them if something goes wrong
No,
with
I
that
understand
experience.
that.
They cop the blame. So when we come into a new town, if there's particular banks in town or supermarkets or petrol stations or pharmaceuticals go there, or we've already got those guys.
Well, amazing,
So
fantastic.
we just start to pick up that 1 or 2 nights from every other property,
and
and that's all we need.
and also that corporate, it's high yielding, right? They're not spending their own money. It's not as sensitive. It's not as demanding. I know I go in late.
Well,
Take
they are
go-
demanding, but for a specific set of
Beg
criteria.
your pardon. So
Yeah.
when I say demanding, they're in and out. I'll often leave a room. I've had a shower. I've slept on one side of the
Yeah,
bed.
that's
And I'm
it.
out.
We do actually change the sheets,
Yes,
even if you've
I'm
only
glad
used
to
half
hear
of it.
that, exactly. Bit of makeup on there. Tell us about your funds and the investors in your funds and the returns, if you can, or roughly.
Yep. So Fund One's been going so all our funds start off as a 5-year fund.
Yes.
We're just not very good at selling stuff. I'm sorry.
Gonna say, we
Fund
Yes.
One, we've been going for 15 years now.
Yes.
Average returns on that are about 23-24%.
Wow. And that's
including
because
COVID.
it's leases over time.
That's leases over time.
Yes.
So it's a lot smaller than it was. We've exited
Yes,
3.
yes.
In one case, we doubled our money. In 2 cases, we halved it.
Yes.
As I said,
Yep.
they're different risk profiles.
Yes.
And we're down to 1 lease in that, and we'll hold on to that for long term.
Yeah.
So that's fabulous first
Yes.
fund. That was an unregulated fund because it's what we call friends, family and fools.
Yes.
So basically it was us and a few friends came in, and then
Yes.
some of their friends, and that was it.
Yeah.
But everyone is delighted with that.
Imagine.
We
yes.
then 10 years ago we switched to a regulated fund.
Yes.
So we've got an AFSL, a trustee, custodian, advisory board. All the checks and balances.
Absolutely, yes.
So the Fund 2 was launched about 10 years ago.
Yes.
It was supposed to be a 5-year fund.
Yes.
A year and a half ago, our investors voted to extend it for another 10 years.
Yes.
So
they're great assets.
So basically, they're just saying, as long as these are good assets, keep it going. Why not?
Why not?
The returns are great.
No one's
The
building
capital
new
growth
ones.
is good. They're de-risked. So we started off at a 55-60% LVR.
Yes.
Interest rates were actually higher than they are now, or even were
Yields were
a
high
year ago.
too, though.
Yields were high.
Yep.
And then over time, we've actually generated enough spare cash to keep doing the capex we need to do.
Yeah,
So
wow.
your 5-year horizon involves this much capex
Yes.
and taking this much risk.
10 years.
But
is
when
it.
you go to 10 years, and now the 10 years is going to be another 10 years, we've got to keep the product fresh.
That's bathrooms and so on. You can't get
all
away
that.
with anything.
But it means our profits are getting higher, and we
Yes.
funded all of the capex from our profits that we didn't distribute to the investors, and we still managed to get out about 10-11 cents per unit.
Wow.
And
after leveraging, obviously, that's
Well,
net to the,
but now the asset value's gone up over the
And
10
those huge
years.
capital gain play at
and
the end.
Well, we think the unit price has basically doubled in 10 years.
Wow.
So you're getting a
that's some
7% return,
profitability.
7% return plus the 10-11% cash. So that's what we call a mid-teen mid to high teen rate
So you
of
get
return.
7 a month, and then when you come to sell, you believe it'll be about 10%. Is that what you mean?
Other way round. They're getting
wanted to confirm,
they're getting 10 cents cash.
Yes.
Every year.
Yep.
Thereabouts.
Paid monthly?
Some years
Quarterly?
quarterly. Yeah.
Quarterly, yep.
Some a little better, some
Yeah,
a little
sure.
worse.
And you share in it after costs?
Oh,
Yeah,
so
so
all the management, everything's that, and we have kept back cash to do the capex.
Yeah, fantastic.
So they
Yeah.
haven't had to put their hand in their pocket. But now the bank's delighted because our loan to value ratio has gone from where we started at 55, 60 is now down in the 20s.
And so when you come to sell,
So we're very conservatively geared,
you are,
very
I
conservatively
know
run.
that.
We're
To be
very
fair,
risk adverse.
All
Yeah.
joking aside, we've done enough transactions that I do think we've
Yeah,
recommended so
you
many clients for
you hate all the questions I give you.
No, but we've recommended all the clients because,
Yeah.
you've got a proven track record and you've got the experience in this
Well,
scale.
it's been a long time, and it's we've learnt from all of that as well.
And the market's moved in real time, but yours
So-
will
and hence-
continue to get tighter. The profit will continue to get higher, like it's a perfect storm, isn't it,
Isn't
for
it terrible?
everybody?
Yeah, our investors are so sad when we tell them
bet
that.
they are.
But they're coming to terms with it, and hence why none of them actually sell. I think we've lost, in Fund 2, we've lost more investors to basically cancer than we have to people wanting to come out because they think it's not the best investment they've got. And often when they do die,
Yes.
their kids keep the
Yes,
asset.
unbelievable, they do.
The kids are like, don't
Yes.
sell that, we want that.
I hear that all the time from anything that's syndicated,
Yep.
Next Generation, because they're so then when you do, as and when, then you share percentage-wise after obviously the costs and your fees and stuff, which we don't need to go into, but so they enjoy the upside too, so they might
Totally.
walk out with double the money. Or
They'll get the capital gain when we sell things.
wow, great! Well, it's a no-brainer, isn't it?
Well, so a lot of our investors are, self-managed super, retirees, people who are looking for, good returns,
Yes.
but also something that will beat inflation in the long term. So
Wasn't when you
they're happy
started.
with the yield.
Yes.
And then over time, they're saying, well, actually, the inflation's covered by the capital growth, and I'm still getting, 10% returns. Gee, why would I?
Isn't it
why would I sell?
unbelievable when we used to say if you had the Taj Mahal but no one was staying there, it had no value. Obviously, people with population growth alone, weak dollar.
It helps.
It's a good story. But it never used to be a capital gain play per se, the accommodation industry, right? Yeah. I never used to sell it as that, but I know that
it's always been a great way of
nowadays.
property generally is a great way of keeping up. So you've got the operating value of a business, but you've also got like this property floor. So, you've seen plenty of properties as have I that are literally not trading and they're still worth something. It's not like they're worth nothing.
And at the moment,
and it's
when
not
you've
land
seen them
value, it's a lot
repositioned.
more than land value.
Yes.
So, yeah.
Yeah, and we've seen that a lot we've sold quite a lot of properties to the government or leased it to the government, or they've been converted to affordable living, or they've been, so, because you need accommodation.
Yep.
So then you've got a lot of people who would reinvest with you. Where do you see the appetite now from the
Our
market?
average investor is in multiple funds.
Yes, right.
So Fund 3 has slightly lower returns because the market had shifted.
Yes.
That's the yield compression you're talking about over time. But also we wanted more freedom to add more value.
Okay,
And so we actually said if we set a high hurdle, then we've got to put all our effort into making that number.
Yes.
And then if we go above it as we have, we can pocket that away for investing in future things. And so it becomes a super conservative, but it also kind of handcuffs us from doing those bigger renovations where we can add a lot of value. Now, I don't want to do that every time, but to put that in the portfolio where you might double the capital value of the property in 2 or 3 years and, massively jump up the yield, surely you want 1 or 2 of those in your portfolio.
Can I tell you,
So-
you're as buoyed as I am with it, and obviously you've got real cold face. We only see it transactionally. We've seen so much activity. But I don't think you can spend too much on properties, really. I know what you're saying about the right property and right locations, but it's great to see tariffs have been reset. I hope...
There's a bit more that needs to come, I think.
I think so too. I don't think we're there yet, and I really hope while things normalise, people's memories are so small. I always think... of things like the floods, and then a year later you're selling them houses on the river. People's memories are small, which is good. It's our positive mentality to keep moving forward. But it does mean that they've forgotten what was normal very quickly. And so I hope that the industry holds. I always joke, don't I, that we'd be like the mafia, hold the rate. The profit's in the rate. If the occupancy dips 5%, when it's been so high, hold the rate.
There's some great so there's a difference between a great town and owning a property in that town.
Yes.
I'm sorry to any listeners who are from Dubbo. Dubbo is a great example of this. The fundamentals of Dubbo are amazing. It's a regional centre, it's got government, it's got agriculture, it's got transit tourism, it's got so many things going for
it's
it.
huge always, from a buyer point of view, so the perception,
Yeah, the problem is with a very few exceptions, most of that town is 30-room properties run by mum and dad. And the problem with that is, remember the good old days of sandwich boards, the A-frames out the front, saying, $100 for a room and the hundreds crossed out and
it was
95
ridiculous,
crossed
and they'd
out.
go down.
It was a
down the
race
road.
to the bottom. And the problem is the internet and OTAs in particular have made that even worse because
We're taking 20 cents of
now
it,
they don't have to
15.
walk out the front and use a texter to change the
Exactly.
rate again. And so a town like that seems to be on a bit of a mutual suicide pact.
But it won't. I think all it needs,
What they need to do is come, like in their own minds, each of those 30 operators needs to agree, we will never sell anything in this town for less than $130. Now, that's not price fixing, that's reality, because by the time you add up all your costs of these things,
there's no money in it.
there's no money in it. And where they're discovering the problem is when they come to sell their property, basically they've had a lovely living for a long time, but nobody wants to buy it because the profitability is well down on what it could be.
Do you know what? I have to correct you there because there's 3 deals that are being done there at the moment, so I'm aware. But I think
And you didn't
they
show
might
me
not
them,
get
why?
the price. Well, because Dubbo's fundamentals don't match the reality apparently. But no, there are buyers. It's just whether the price for the scale. I think there are buyers for big properties like that. The town. I think it's one of those towns
big properties,
that will.
No, big properties totally different because they can play in their own
When
space.
I say 30 keys, right? I
Yeah.
think 30 keys. I think if you own a 30 key property in Dubbo, you can make good money out of it. But I understand what you're
Not
saying.
under management, and you've still got this.
Yes, and
Everybody's
also
racing.
I know what you're saying about, I always talk about Quest, right? We've been the Quest agent for so long, and people always say, oh, Quest is coming to town, they get nervous. It's a good thing, can I tell you, they come in, because of the cost of build, they have to hold the rate.
Yep.
They're trained to hold the rate. They've got support behind them to do it.
Yep.
They know long term it's the most profitable.
Yeah.
And 9 times out of 10, the whole town
lifts. Yeah.
which is fantastic. John, we're out of time. We haven't even talked about where you want to be next.
Oh my goodness.
We will get you back.
We will.
Hey, thank you.
Good to see you.
Ladies and gentlemen, thank you so much for joining us. And John Zeckendorf from Mandala Hotels and Resorts.
Thank you.
Thank you. Thank you so much for joining us at Resort Brokers Radio. Please subscribe and follow us and give us a 5-star review so we can be back again next time. Thanks a lot.